Views regarding the economy, securities markets, or other specialized areas, like all predictors of future events, cannot be guaranteed to be accurate and may result in economic loss to the investor. Past performance is no guarantee of future performance. Any information is for illustrative purposes only and is not intended to serve as investment advice or as a recommendation, since the availability and effectiveness of any strategy is dependent upon your individual facts and circumstances. Individual securities discussed may be held in accounts where JGUA and or its employees have a beneficial interest. And with that, let's get to this week's episode.
Hey everybody, Dr. B here with John G. Ullman and Associates. This is our weekly market update for the week of November 25th. If you're new here, thanks for joining us. If you're a regular, thanks for coming back. As always, my goal with this podcast is to use my background in economics to help you better understand the economy and the markets so you can make an informed financial decisions. Keep in mind, you can always drop your thoughts or questions in the comments, and I'll do my best to get back to you. So with that said, let's get ready to hit the books and get up to speed on the markets. Leading off the discussion from last week, we saw the October update for the leading economic index. Unfortunately, we saw the index continue to decline as it has done in recent months. Unfortunately, the manufacturing sector continues to contract and continues to bring down the index itself as a whole. And unfortunately, the Federal Reserve's high interest rate policy, in their attempt to stabilize prices and fight inflation, also tends to pull this index down. In last week's video, we mentioned this would be a very housing-focused week. And as promised, we have several updates on the housing market. First, the National Association of Home Builders Home Market Index increased, showing optimism among construction and home builders. We also saw a significant increase in the October numbers of existing home sales. But unfortunately, at the same time, we saw housing starts, building permits, and housing completions all fall significantly in October. Unfortunately, this has been a mixed report, a little bit of good news mixed with a little problematic news. So as usual, we'll continue to watch the upcoming reports and continue to bring you the information as it unfolds. Before we talk about the market, I want to share a tool with you that many economists and market watchers use to try to understand the volatility in the market and the risk or anxiety that may exist in the short term. So this tool is the Chicago Volatility Index, often referred to as the VIX. The VIX attempts to estimate over the next 30 days what the speed and magnitude of price changes may look like in the stock market, specifically the S&P 500, based on the trading of options. We'll talk more about options in another video, but ultimately what this tells us is how much are traders in the market expecting the prices of the stocks to rise or fall at any given point in time. So we tend to see the volatility index rise when big economic reports or the Federal Reserve's interest rate decisions or big geopolitical events like the election are preparing to take place. We see the index climb, and then once the event has passed, we tend to see the index fall. So a great example of this year has been the election. We saw a big increase in the volatility index leading up to the election, and then immediately following the declaration of the results, we saw the volatility index drop significantly. Now, recently, we've actually seen this volatility index climb a little bit in the last week. One of the ongoing theories for this drop is that we're starting to see more political volatility with the Trump administration's selection of their cabinet members and more open and determinate statements about their future policy positions. We're also seeing escalating conflicts and geopolitical tensions in Asia, in Europe, in the Middle East. We've recently seen this index rise, indicating that the market is expecting big changes, either up or down, on a day-to-day basis. Right in line with the increased volatility, we saw all three major stock indices increase by more than 1.5 percentage points last week. We specifically saw increased volatility in the Magnificent Seven tech stocks. Google continues to struggle with antitrust cases, and it was suggested that the Department of Justice may attempt to force Google to separate itself from ownership of the Chrome browser in order to break up some of its monopoly influence. We also saw a fantastic earnings report out of Nvidia, and Nvidia up to this point in 2024 has been the envy of most companies, and not just most tech companies, as they've continued to repeatedly every quarter beat their earnings per share expectations, beat their revenue expectations, and beat their profit expectations by a significant margin. Nvidia's share price both rose and fell this week at different periods, as investors struggled with the contrast between how impressive their third quarter results were and concern that the company may not be able to sustain these incredible performances into the future. Nvidia expressed some concern about their supply chains, as well as a slightly more reasonable revenue expectation for the fourth quarter, and the markets weren't quite sure if they were impressed or concerned that this growth may not continue at the same speed. We can't wrap up our conversation about last week without talking about Bitcoin. The incoming Trump administration has voiced significant support for Bitcoin, as well as broader deregulatory efforts in the cryptocurrency space. Bitcoin specifically has benefited from this, and we saw the value of Bitcoin rise to almost $100,000 by the end of the week. The ongoing question with Bitcoin is, when does it become a broadly accepted legitimate commodity, and whether the current enthusiasm for Bitcoin, as well as other cryptocurrencies, is just another example of historical irrational exuberance and excitement following the change of political administrations in the United States. As we close out the third quarter earnings season for 2024, we can confidently say that this has been a mixed reporting season with a generally positive bend. We've seen 7 out of the 11 S&P 500 sectors reporting year-over-year earnings growth, and 9 out of the 11 sectors reporting year-over-year revenue growth. Unfortunately, that means that 4 of the sectors showed a year-over-year decline in earnings, and 2 of the sectors demonstrated a year-over-year decline in revenues. The energy sector occupying both of these negative sides of the market. As we look more closely at the reported results and the reaction of the stock market itself, we can see a very clear trend coming out of the third quarter that companies that were able to achieve or exceed expectations were rewarded by the market with higher share prices, while simultaneously companies that failed to exceed or even failed to achieve expectations in the first place were harshly punished by the market with significant stock share price drops. This isn't unusual, and in fact, this is a good demonstration of the market working in exactly the way that it's intended to. We tend to become somewhat preoccupied with the speculation that happens in the market from the day to day. At the same time, most traders and most investors will tell you that the long-term trends of most stock markets are driven by fundamental performance, things like earnings, revenues, and profits. So seeing the market reward companies that exceeded expectations and punish companies that failed to achieve those expectations is just another excellent reminder that fundamentals drive stock prices. far more than any sort of emotional or headline-driven change may temporarily impose. And since the election, we've also seen that markets are watching the incoming Trump administration. Initially, we saw the excitement and exuberance around the potential for deregulation, corporate tax cuts, and Trump administration support for cryptocurrencies. Lately, we've seen the stock market demonstrating some concern as the Trump administration continues to lay out policies and as Trump himself begins to nominate individuals to positions within the government of significant influence. Specifically, we've seen a negative reaction in the healthcare, particularly the pharmaceutical industry, as a result of the nomination of Robert F. Kennedy Jr. as potential Secretary for Health and Human Services. We've also seen some ongoing concern with the potential for non-renewal of large government contracts, including defense contractors and general government contractors. And one of the most prominent positions that hasn't been filled yet is the Secretary of the Treasury. The belief in the market is that the Secretary of Treasury nomination will actually provide some insight as to the direction and the potential for future Trump economic policy. So as we continue to watch this week unfold, if we happen to see a nomination for Secretary of the Treasury, we will most likely also see ongoing discussions about the economic and financial market impact of that individual and their stance on some of the most common Trump policies. Coming in later this week, we'll see some updated information on housing prices and affordability, as well as some significant economic reports on gross domestic product and the PCE measure of inflation. In fact, due to the holiday, this shortened week will see a significant amount of economic data released on Wednesday afternoon. So expect Wednesday and most of the headlines to follow to be heavily invested in the current condition of the economy and speculation about where the economy may be headed for the remainder of this year, as well as 2025. As we look to the future, we'll be watching the ongoing developments of the Trump administration and the potential for new economic direction and policies going into 2025. We'll also continue to watch as we move through the holiday season, as the retail and consumer spending numbers come out to wrap up 2024, given that our economy is predominantly made up of consumer spending as a key component, this will be a critical piece of information in understanding where we're headed in 2025. We'll also continue to watch housing and manufacturing, as these two areas continue to struggle. And in order for the economy to move forward in a robust, sustainable way, we will need to see performance and some turnaround in these two areas. Finally, as has been the case for months now, we'll continue to monitor the inflation and unemployment data, as well as the decision that the Federal Reserve makes in December and in 2025 about interest rate policies. When new information is released, we will do our best to capture it and bring it to you here. Make sure that you have all of the information and a good understanding of the implications for this data on your decision-making process. As always, we'll watch these developments as well as any others, and we'll do our very best to bring you anything that we think will be helpful and keep you up to speed on the markets. Don't forget to like and subscribe if you found this video interesting or informative, and don't forget to check out the other content here on the John G. Ullman page. With that said, thank you for joining us, and have a great week.